Today's market fall was not equal across all sectors, as IT and metal stocks led the decline. IT stocks faced significant downward pressure due to widespread global technology selling and cooling overseas demand. Indian technology firms rely heavily on international clients, particularly those located in major developed global markets. When global corporations reduce their spending on technology, consulting, cloud projects, or complex digital transformation services, the revenue growth outlook for Indian IT companies becomes increasingly uncertain, prompting investors to exit positions. This reaction is a direct consequence of the market's sensitivity to global technology spending trends and cycles. Simultaneously, metal stocks were under heavy pressure because they are deeply linked to global economic growth. Industrial metals are essential raw materials for manufacturing, construction, and infrastructure projects across the entire world. When investors worry about slower growth in major economies, they immediately become concerned about lower demand. Lower demand for industrial metals directly impacts the profitability and revenue projections of major metal companies. Weaker commodity prices often signal a broader slowdown in industrial activity, which further dampens market sentiment. The profitability of these firms is highly dependent on global commodity prices, which remain volatile today. As global growth fears persist, the demand for metals is expected to remain under significant short-term pressure. Investors are closely watching these sectors to gauge the depth of the current global economic slowdown. The pharmaceutical sector, by contrast, demonstrated remarkable resilience throughout the duration of the trading session. While IT and metal stocks plummeted, pharma stocks held their ground, acting as a defensive cushion. This divergence highlights the defensive nature of the pharmaceutical industry during times of heightened market volatility. Investors often rotate capital into defensive sectors when they perceive increased risk in the broader market. The ability of pharma to withstand the sell-off provides a clear contrast to the high-growth sectors. Traders are now evaluating whether this rotation into defensive stocks will continue in the coming days. The market remains in a state of flux as participants weigh the risks of further global contagion. Understanding sector-specific reactions is vital for interpreting the underlying health of the broader financial markets. The interplay between global demand and domestic sector performance remains a critical theme for all investors. As the trading day concludes, the focus shifts toward future earnings reports and global economic indicators. Market participants are preparing for continued volatility as they adjust their portfolios to new economic realities. The current environment demands a disciplined approach to risk management and a focus on long-term fundamentals. Investors should remain vigilant, monitoring how these global trends continue to influence domestic market performance daily. The resilience of certain sectors offers a glimpse into how the market balances growth and risk. As we look ahead, the correlation between global technology demand and Indian IT performance remains paramount. The metals sector's sensitivity to global growth serves as a barometer for the health of industrial activity. The pharmaceutical sector's stability provides a necessary balance in a market characterized by rapid price swings. Traders are analyzing these patterns to identify potential opportunities amidst the ongoing market-wide correction phase. The broader market sentiment remains cautious as investors await further clarity on global interest rate policies. The combination of these factors creates a complex landscape that requires careful and analytical market observation. Every movement in the indices reflects the collective decisions of participants navigating this challenging financial environment. The current volatility is a reminder of the inherent risks present in globalized financial market structures. Investors are advised to maintain a long-term perspective while navigating the short-term noise of the market. The focus on earnings quality and balance sheet strength becomes even more important during these periods. As global liquidity tightens, the quality of assets held in portfolios will determine overall investment success. The market is currently undergoing a period of re-evaluation, testing the strength of previous support levels. traders are observing the volume of selling to determine if the downward momentum is truly exhausting. The role of institutional investors in this sell-off cannot be understated, as their flows drive trends. Retail investors are encouraged to stay informed and avoid making impulsive decisions based on daily news. The educational focus of this analysis is to provide a framework for understanding complex market movements. By breaking down the reasons for the fall, we aim to provide clarity during times of uncertainty. The market will continue to evolve, and staying updated on global developments is essential for success. We have examined the triggers, the sector impacts, and the underlying macroeconomic concerns affecting the market. The path forward involves monitoring how these global pressures translate into domestic corporate performance and growth. Investors must remain patient as the market finds its new equilibrium in this changing global landscape. The lessons learned from today's session will serve as a foundation for future investment strategy decisions. Market corrections are a natural part of the investment cycle, providing opportunities for disciplined, long-term investors. The focus remains on identifying the drivers of volatility and understanding their impact on asset prices. As we conclude this analysis, remember that markets are inherently unpredictable and require constant, careful observation. The data suggests that the current weakness is a reflection of global sentiment rather than domestic failure. Investors should continue to monitor global bond yields and the strength of the dollar as key indicators. These metrics provide insight into the flow of capital and the overall risk appetite of the market. The resilience of defensive sectors demonstrates that not all areas of the market are equally affected. Staying informed and maintaining a balanced perspective is the best approach for any serious market participant. We will continue to track these developments and provide updates as the market environment evolves further. Thank you for joining this educational session on the factors driving today's significant market movements and trends. Building upon this global instability, domestic factors began playing a pivotal role in today's market movement. Recent economic data indicated a cooling in private sector business growth and overall services activity levels. These figures provided a clear catalyst for traders to initiate aggressive profit booking following a rally. The market had enjoyed a 7-session winning streak, leaving many portfolios ripe for a correction. This downward pressure was particularly pronounced within the IT and metal sectors of the exchange. Investors weighed the potential impact of slowing international technology spending on these specific high-growth stocks. Simultaneously, concerns regarding industrial commodity demand further dampened sentiment across the broader metal sector indices. The Indian rupee faced significant downward pressure, adding another layer of complexity to the day. Derivatives-related unwinding further exacerbated the intraday volatility, causing indices to swing wildly during trading hours. However, it is essential to view these sharp movements through a lens of short-term uncertainty. Rather than succumbing to panic, one should recognize that market corrections are often quite necessary. They serve as a natural mechanism for rebalancing when investor expectations become far too optimistic. As the market navigates these multifaceted challenges, maintaining a disciplined long-term perspective remains absolutely crucial. Investors are advised to carefully monitor key support levels and shifting global liquidity trends daily. Always remember that this analysis is provided strictly for educational purposes and not financial advice. The current environment demands patience as the market seeks a new equilibrium after recent gains. Traders must remain vigilant as domestic sentiment continues to react to these evolving global signals. The cooling growth data serves as a reminder that economic cycles are inherently fluid processes. Profit booking is merely a logical response to the stretched valuations seen throughout the previous rally. The IT sector remains sensitive to the broader narrative of global technology capital expenditure shifts. Metal stocks reflect the ongoing uncertainty regarding industrial demand in a tightening global economic environment. The rupee's fluctuation highlights the interconnected nature of our domestic economy with global currency markets. Derivatives unwinding often amplifies price movements. creating temporary dislocations that do not reflect fundamental value. Short-term volatility is the price investors pay for participating in a dynamic, globalized financial system. Wise investors look past the noise of a single day to focus on long-term trends. Rebalancing portfolios during such corrections can often lead to better risk-adjusted returns over time. Support levels act as psychological barriers where buyers may eventually step in to stabilize prices. Global liquidity trends will continue to dictate the flow of capital into emerging market equities. Understanding these mechanics helps retail investors avoid making emotional decisions during periods of market stress. The cooling services activity data suggests a period of consolidation is healthy for the economy. While the 7-session rally was impressive, a pullback allows for a more sustainable growth trajectory. The IT sector's retreat is a direct reflection of the broader global tech sector's current. Metal producers face headwinds from global industrial demand, which remains tied to international economic health. Currency pressure reflects the broader strength of the dollar, which often draws capital away globally. Derivatives activity often creates a feedback loop that can exaggerate the speed of market declines. Panic selling is rarely a sound strategy for those with a long-term investment horizon today. Market corrections are simply the market's way of resetting expectations to a more realistic baseline. Maintaining a long-term perspective is the best defense against the volatility of the current market. Monitoring support levels provides a tactical advantage when navigating these periods of heightened market uncertainty. Global liquidity trends are the primary driver of institutional capital flows into our domestic markets. This educational analysis aims to clarify why these corrections occur within a broader economic context. Financial advice should always be sought from certified professionals before making any major investment decisions. The interplay between domestic data and global sentiment remains the defining theme of this session. Investors should remain calm and focus on the underlying fundamentals of their specific portfolio holdings. The cooling of private sector growth is a signal to adjust expectations for the coming quarter. Profit-taking is a standard practice for institutional investors seeking to lock in gains after rallies. IT and metal sectors are currently the focal points of this broader market rebalancing effort. International technology spending remains a key variable for the future performance of Indian IT firms. Industrial commodity demand is closely linked to the health of the global manufacturing sector today. The rupee's movement is a barometer for foreign investor sentiment toward emerging market assets overall. Derivatives-related unwinding will eventually subside as the market finds its new, more stable footing. Short-term uncertainty is an inherent feature of any liquid and transparent financial marketplace worldwide. Natural rebalancing mechanisms ensure that market valuations do not drift too far from economic reality. A long-term perspective allows investors to ride out the temporary storms of market volatility effectively. Support levels are essential tools for identifying potential entry points during a market-wide correction phase. Global liquidity trends are influenced by central bank policies and international interest rate environments globally. This educational overview provides the necessary context for understanding today's complex market price movements. Always consult with a qualified financial advisor to tailor these insights to your personal needs. The market continues to digest the latest data while searching for a stable support floor. Stay informed, remain patient, and keep your long-term investment goals at the forefront today.